Everybody, welcome to Intermediate Accounting 17th edition of Video Solution Walkthrough. This is for Kiso, Weingen, and Warfield, problem 19.4. The textbook authors are Don Kiso, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within are those of Bennett Tchaikovsky, not the authors of the textbook or of Wiley. Okay, so before we say thank you, Wiley, let's go ahead and do the question. So this is problem 19.4. We've got permanent and temporary differences with one rate. So right over here, we'll start actually the last part first. So we're asked to do a schedule starting with pre-tax financial income and ending with taxable income in 2020. So our pre-tax financial statement income is going to be $750,000. Okay, so that's our pre-tax financial income. Let's go ahead and take a look at this. Now, number one, which is life insurance expense. And if you remember going back per our previous discussions, this is what is known as a permanent difference, meaning that the proceeds from the life insurance policy in an officer are not taxable, but those premiums are not going to be deductible. So this is a permanent difference, life insurance premium. This is an add back. Okay. Equipment was acquired in early January for $300,000. Straight line depreciation over a 5-year life is used with no salvage value. For tax purposes, Chenault used a 30% rate to calculate depreciation. So this seems like in the solution, it's basically for tax purposes, you're basically taking 300,000 times 0.3 or 90,000, a 30% tax rate is what it is. Okay, so we were doing that with the 30% tax rate. So for tax purposes, we're going to be taking a deduction for 90,000. But for financial statement purposes, what are we going to be doing here? Well, our acquisition cost minus the salvage value divided by the estimated useful life. Our salvage value is 300,000. Salvage value is 0. Estimated useful life is 5 years. So this is going to be $60,000 per year. Okay, so when I look at this, what is happening here, right? So this is going to be, well, for financial statement purposes, I deducted 60,000, but for tax purposes, I could have deducted another 30,000. So over here, this difference is going to be 30,000. So over here, this is going to be a temporary difference, depreciation expense. Now, because this is a temporary difference, what is going to happen in 2021 is this is going to reverse. So I'm going to have to pay more tax because I'm going to take less depreciation in future periods relative to the tax. Okay, depreciation. Interest revenue on the state of New York bonds totaled $4,000. This is what is known as a municipal bond interest. So this is interest on munis. And so right over here, this was income for my pre-tax financial statement income. However, I don't have to pay tax on it, so I'm going to take out $4,000, right? So again, that is a permanent difference. It is not going to reverse. Product warranties. Okay, so over here for financial statement purposes, I went through and I deducted, okay, estimated to be 50,000. So my warranty expense would have been $50,000 because I have to go through and record them in the period I make the sale. Actual repair costs related to the warranties were only 10,000. So for financial statement purposes, right, I was taking a deduction of 50,000, but for tax purposes, I'm only taking a deduction of 10,000. So what this is this is going to be an add back to my net financial statement income. Remember, what's happening here is I took 50,000 off to get to the 750, but for tax purposes, I'm only allowed 10,000. So I have to go through and add back $40,000. Now it tells me over here that it basically says the remainder is expected to be paid evenly between 2021 and 2022. So what's going to happen here is because I'm paying money on these warranties, on the tax on that income now, or tax on the expense now, I'm going to be able to deduct that in the future. Okay, so this will be giving me a deferred tax asset. All right, gross profit on the accrual basis was $100,000. Okay, so for financial statement purposes, I had over here for $100,000. But for tax purposes, it was only $75,000. So when I look at this over here, I'm not going to have to pay, because this includes $100,000, but for tax purposes, I only have to pay $75,000. So what I'm going to do is I'm going to deduct out this amount right over here of $25,000. So this is gross profit on the contract. This is going to reverse out in the following year or the following years, and that's fine. Okay. And this really doesn't, like, in terms of it reversing out, it can make a bigger deal if our rates are going to be changing, but for general purposes right here, we're good to go. Fines for pollution violations. So I deducted $4,200, but for tax purposes, I'm not allowed to do that. So I'm going to add back over here of $4,200. So my total taxable income, is going to be the sum of these values right up here. And it's going to be $744,200. So that is my total taxable income. My tax rate is going to be 30%. So my income tax expense current and my income taxes payable current is going to be $233,260. Let's do the journal entry. So first thing we want to do is let's go here on 12/31/20. Let's go ahead and prepare that journal entry. So I'm going to have over here, I'm going to have income IT expense current. I'm going to have income taxes payable current. And this is going to be for $223,260. Next thing I'm going to go through and do now is I'm going to figure out what are my deferred tax assets and what are my deferred tax liabilities. So my deferred tax assets are going to be right over here. And I'm just going to kind of shift things around a little bit just to make it a little bit easier. And let's go ahead and give us some more room. Okay. So as I look at this over here, my total, let's start with our liability. So I was able to deduct $30,000 and $25,000 this year. Part of it was I took more depreciation expense for tax. And I didn't have to recognize all my income for financial. So over here, this generated a deferred tax liability of it generated future taxable income to me, or future taxable amounts of $55,000, my 30% tax rate. So this is going to be my deferred tax liability. So right over here, I'm going to have a deferred tax liability of $16,500. Now, in terms of the deferred tax asset, in terms of the product warranties, I was not allowed to take the full expense this year. So this is going to create $40,000 worth of expenses in future periods. So over here, I'm going to have a deferred tax asset of $12,000. So right over here, I'm going to have deferred tax asset of $12,000. Okay, so whatever I need to do to balance is going to be my income tax expense deferred. Okay, so my income tax expense deferred is basically going to be 4,500, or the difference between the deferred tax asset and the deferred tax liability. So as I look at this over here, my total amount over here is basically, it's going to be 12,000, but be 4,500. So this is going to be my journal entry. Now, if you're looking at the book solutions, what the book solutions will more than likely show is they're going to show basically 227,760. And that is correct. That's the total amount of the income tax expense. However, for our purposes, I'm breaking this out intentionally because if we were to go through and show a schedule, right? If we were to basically say, okay, what's our taxable income, or what is our, let's see right over here. So our pre-tax financial income is 750,000. Okay, so less our income tax, less our income tax expense current, less income tax expense deferred. So our current income tax expense was 223,260. Our deferred income taxes are 4,500. So our total income tax expense is going to be 227,760. Our taxable income, or our net income after taxes, is going to be 750 minus the 227,760. So again, I'm doing this intentionally just so that when you go through and look at this, that you know where these numbers are coming from. So that's problem 19.4. I want to thank Wiley here today for allowing me to continue to go through and to use their material. Please don't forget to like and subscribe. If you'd like to see other solutions in the future, please feel free to ask for them in the comments. Have a great day.